What's up, gang? Good to see you. Happy Friday. Happy OPEX. Nope, don't. I'm not going to rename you. I'm just going to make you a panelist.
Good morning, good afternoon, good evening, wherever you are.
all of that.
All of the above.
Good morning, good afternoon, good night. Yeah. Well, hey, gang, welcome to another skill enhancement session. Happy Friday. It is OPEX. It is, we just had rig count in crude. I think they were like down, what did they say? 6 more. 66 rigs. Wow. Nobody wants the Texas Gold. the black tea.
It brings back a song. It has my name in it.
It does bring back a song. So if you as we go along through here, if you have a question, feel free to use either the chat or the Q&A session. But we're just going to launch right into this and see what interesting places it takes us, and hopefully this adds some value to what you're looking to do. And with that, let's jump in, shall we? So first, just a reminder of the fact that we do trade vehicles that have risk, and we're going to talk a lot about risk today, and how to protect yourself from that. But futures specifically are a risky instrument, and those are the ones we'll look at as examples. But futures, options, equities, whatever you like to trade, there's risk around that, as well as there also being opportunity. I'm Josh. I'm the founder of Trade Profile. Started out on the retail side, eventually got so hooked on this that went to the institutional side, and I've always really enjoyed doing development. That was, like helping people make better decisions. Just especially even from being on the brokerage side, it was hard to watch people place trades over and over again where I knew that was not going to be a winning trade. it was tough. So it makes me think a lot about process. And Jed's with me on the line as well. Between the two of us, we're kind of the core of the Trade Profile team, and we're a skill development firm. Like we exist, and a number of you are part of the community. Guys, we're here to help you build your skill and build your consistency, and we do that through a process that we've honed called our profile trading development pathway. And it's, like I think there's lots of people out there trying to teach people how to trade. People want to learn how to trade, and it's a hard business, and it is a business that rewards those who approach it with rigor, but it's a hard one to learn as well. And we've tried to take what we've gleaned and what we've seen work on, especially the institutional side, and bring that into a more accessible retail space, but so that you can do that from a professional viewpoint. And we do that through this pathway. It's a 16 module. A lot of people, it takes 4 months to get through, unless they want to do it in a more accelerated venue. But to build holistically, not just like what's a trade setup look like, but like why would that setup work? Why does the auction do what it's doing? Like, you look at a chart and you're like, I don't understand why it's doing what it's doing. It doesn't make any sense. It helps explain some of that stuff. And today we're actually going to look at a specific aspect of something that we're going to be talking about next week with our community. So if what we're talking about right now kind of wets your whistle, it'd be a good opportunity to spend time with us next week. But if I further unpack where our thinking and approach to how we lead towards consistency, it's really around these 3 areas. And everything that we do kind of comes back to these. And the overlap of these 3 ideas is where we find consistency, and have found consistency with the traders that we've been blessed to work with. So one is the 4 behaviors observable in every auction. So this kind of speaks to the, do I actually know how to read an auction, and why is this price likely where this price may not be likely? 4 questions to ask before entering a trade. I'm going to come back and refer to these in a little bit. Before we put a trade on, we ask 4 questions and we answer those 4 questions, or we don't take a trade. It's that simple. So think about like the last trade that you put on. Did you ask yourself questions, or did you just go? And if you're not yet consistently profitable, likely don't have the instincts honed yet, that's part of your problem, to be quite blunt. And then finally, the 4 stages of auction competency and how to know which one you're in. And this is a stage 1 is I don't know what I don't know. And we all started there. Like when I got started, I had no idea. I didn't even know how to place a trade. Like I don't even know, how do I get an account? How do I actually place an order? So I remember I was thinking the other day, like I didn't even know how to get in. Like how can I get in the trade? I don't know how to get in the trade.
Those were the days, weren't they?
Those were the days. Now I'm like, how can I not get in the trade? To stage 2 where you are like, oh yeah, there's stuff I don't know about yet. To stage 3 where you have there's things about the auction process, about how markets work that you can trust and that you have some belief in. Just got off the call with one of our traders, and he's like, man, this is remarkable how well he had a number of dynamics. He's like, when they are all firing, he's like, it's remarkable how well and how predictive they are. And I was like, yeah, like it's not rocket science, but it does require critical thinking. And when you see a number of these things stacking probabilities in your favor, you get positive results. Like it does actually work that way. There is mystery that can be removed from the markets. And as you hone that stuff and digest that stuff and work through process and do replays and like, then it leads to the stage 4 where it's instinctive. And then you are making trades based on instinct, and you're basically doing all that stuff, very quickly in your brain. But that's the base of what we do. Today we're talking skill development and skill enhancement, and specifically stop placement. So like I've got an email that I send out every once in a while just saying, hey, if there's something I can help you with, what's something that you're struggling with and would love some greater guidance on. And it typically comes back to, hey, I get in a trade and I get out too quick, or I get in a trade and I keep getting stopped out. Like I feel like I shouldn't get it stopped out as much as I do. So I want to talk about stop placement, and we'll look at some examples from today of how to do that. First, like what is a stop? So a stop is a price at which you say, hey, I am out of this trade. And it's an order that you can place. You can place a stop market, you can place a stop limit, and you can say, hey, if it reaches this price, stop market would be if it reaches this price, just get me out at market, whatever the quickest and most expedient price is. Stop limit would say, if I hit this price, now put this order in to take me out. Either one could be effective. But I get questions sometimes like, should I use them? Should I use stops as part of my trades? And I would say absolutely use them. These, if you've been trading at all this year and haven't learned that stops must be used, then this probably isn't the game for you. Yes, we absolutely use them. Where should I place them? So this is the question, is like, where should I place them? So the placement of a stop happens when you put the trade on. So we're gonna identify where that place is when you put the trade on. And the next question is, how can I place better stops? So you guys, you can actually place better stops. When Jed and I do trade reviews a lot with our traders, and we'll look at the specific trades, and the thesis was right, the setup was right, the order flow was right, and then they still got stopped out on the trade. And it's classic thing of like, well, I placed my stops too tight, right? I want to show you some techniques today on how to place tight stops and they still hold, but you got to know what to look for. Should I move them? No. How's that for a definitive answer? No, and these are, and they're all tied to the 4 questions that we asked before we put on a trade. Where you place your stop is basically defining what your risk is. and you define that when as part of constructing the trade. So if I get stopped, then I just know, man, I'm out of the trade. Now, what happens if I'm stopped out? Well, then you get to reassess and say, is the opportunity that got me interested in the trade to begin with still there? If it's still there, find a new trigger to get in, reestablish the stop if that makes sense relative to the potential reward, and go again. If the conditions have changed, then maybe you just say, nope, conditions have changed. The opportunity that was there is no longer there. So now I'm going to be out. Okay. But in all of this, it's all part of staying risk forward. So often, and Jed can correct me if I'm wrong, or if he's heard differently. Often we hear developing traders very, very focused on how much I can make in markets, and it's a lucrative business. It's a business that's easy to scale if you know what you're doing. But if you stay opportunity focused and you don't stay risk focused, you can actually, you could have some good times, and then one day you get blown out and erase much of what you've done over weeks and weeks, and that's just so demoralizing. And so, man, it dings your confidence, and it actually even prevents you from actually putting the trade on when you should, because your brain records that and says, oh man, I can't trust this anymore.
I would say it's also, it runs more people out of the business than
Yeah.
anything else, is that once they get a couple of hits of that dopamine, a win, okay, and that's what we talk about, and then they get flushed, and that's like, oh well, then that's when you start hearing the markets are rigged, and that sends them out of the business, and unfortunately, nothing could be further from the truth, though. So
that's right. So if you stay risk forward, the opportunity will take care of itself. But how do we do that specifically? So here's kind of a quick kind of checklist, and then we're going to look at the markets right now. But here's where we start. So we start with the 4 questions that I alluded to before, and the 4 questions. If you don't know these questions, you can go to our website. You can look at previous Q&As where we've spent specifically looking at these. But it starts with, what's the opportunity? So what is the target? Often traders, when they think of opportunity, they may look at opportunity as there's a certain configuration of price that's triggering me in. That's my opportunity. And we're saying, no, that's the trigger. The where the auction's going to go is my opportunity. And why that's so important is, if I see a specific trigger or behavior that leads me to believe that there's going to be a directional excursion in the market, if I don't know where, or have a rational reason for where that might go, how do I know how much risk to put on? This plagues scalpers all the time. They'll see some price action trigger that gets them in, and then the market goes, if we're talking futures, it could go a few points favorably, and then it retraces, and it was like a 1-to-1. Well, here's the thing: if every opportunity is 1-to-1 risk to reward, you have to have a high win rate to actually make money. Otherwise, you're just swapping winners for losers. We always try to define opportunity by 3-to-1 risk to reward. And here's just a quick example. Okay, today I'm gonna pull up my ES chart here. So an opportunity existed this morning in the S&Ps, and the opportunity was that we had a gap in the auction. So see this price right here? There's a spot right in here where we didn't trade at all. Trump, it was a Trump pump. There were two kind of key announcements. One, we knew there was a planned press conference yesterday after the close, intentionally scheduled after the close, because he knows when the futures open and nobody's home, on when we're going to reopen the economy. Okay, so there's that input. The second is that there was news that Gilead has come out with a potential treatment for the coronavirus, that seems promising. Okay, so this is kind of a, buy the rumor, sell the news type event. So the rumor is, hey, they've got a potential treatment, and we're going to reopen the economy. So that's the dynamic that leads to a really, really strong move overnight. And actually, if you follow stuff I post on Twitter, I've been talking about this 2840 and 2730 area that broke us out of that 2840 to the upside. Okay, so then we come into this morning, and I see this spot, I see this gap, and what that represents is it represents unknown prices in the auction, because we never traded those. We traded those from the close of the auction up to the pause, and then from the reopen overnight. We just never traded those prices. So the auction doesn't know if those prices are valid. When you have structure like that where the auction doesn't know if the prices are valid, you'll often, especially if you're close to that, you'll often find the auction traverse that to try to test it. Added to that was that from this session right here, we had a most traded price at 2836. Okay, that was part of my plan. So that is right in the meat of that hole in the auction. So that creates opportunity of that. If we get close into that, that's my target. So I'm looking for 31 to 36 S&Ps. That's what I'm looking for. So that defines the opportunity. So okay, well then the question is, if that's the spot, what would I be willing to risk to get in there, and what do I lean on to define that trade? And this is, by the way, this is a trade called a structure cleanup trade. So I'm cleaning up structure in the auction, and this is something that the profile is an excellent tool for us to be able to see where there is poor structure in the auction that we might not see in a specific candlestick chart. Okay, so I saw that as opportunity. So that's my first question. What's the opportunity? There's poor structure that I could clean up. Great. All right. So then the next is, what am I willing to risk? So that has to do with, I'm going to go to I'm going to do two things here. I'm actually going to get this bigger here.
And while he's doing that, what are you willing to risk and accept, which is key in the world of trading, because a lot of people are psychologically built not to lose money. They don't want to. And in this industry, there will be times where you take a stop loss, and that's part of the element. It doesn't mean you're a bad person. It just means, hey, my theory was wrong and it didn't work. Okay, on to the next opportunity. But you honor your stops. That's when Josh had, excuse me, that's why he had that definitive answer of, do you move them? No.
No.
So.
No, you do not. Okay, so all right, so this is a 5-minute. Each one of these are 5-minute periods. Okay, and so I typically look at a 5-minute. I can refine it with a 2,000 volume. I've been using about 2,000 volume bar to get even tighter, but I start here with this 5 minutes. So we're gonna just really.
And also, I'll just encourage, if anybody has any questions, drop them in here and we'll get to them throughout the call.
Yeah. Okay, gang. So here's our target zone right here, right? It's to get these singles, and it's to get this naked VPOC right there. Okay, so here's the first thing. Now, this is the contracts on each price traded. Okay, the number at the bottom is the net total between buyers and sellers. On this platform, a positive number means more sellers. Okay, a negative number means buyers. Okay, so here's the open. I'm very close to this prior range. So I'm thinking if I can trade up through the open and trade back through the open and the order flow holds, I could use the open as my stop. That's going to be my risk, and I already know what the reward is. And I'm going to re-enter on the test of the open. Now look at the risk here relative to the reward. This is why it's so important to start with the opportunity first, because then I know, hey, I'm willing to take 4 points of heat on this trade to make about 20. All right, does that make sense? So then those are the first question, what's the opportunity and is it a reasonable opportunity? So that requires you have to kind of understand how the auction works to be able to have, that's how you get better opportunities than others, is that hey, if these conditions are met, it's likely for the structure cleanup to be in place. Second, can I leg into something? The fact that we trade up through the open and come back through it with selling control, that was key. So they were selling it. Then I can defend and basically say, all right, I'm leaning with sellers, and I will defend with the sellers. And then the next question is, what would tell me that I'm right? Well, any counter activity is going to be weaker than what I want to see directionally. And then what would tell me that I'm wrong? Well, if I trade back through that open again with buying order flow, I'm clearly wrong and I need to exit the trade. Okay, now I set the stop one tick above the high, one tick to start. I close this first 5 minutes. Look, we're already almost to the first target. Now, the second 5 minutes could make you wiggle a little bit because they trade, back through half of this first 5 minute range. But note that the volume is less in this period than the prior period, and also where this was 4,000 to the sell side, this is 300 to the buy side. So are they eating into those sellers yet? No. Like, that's just what we would call responsive activity. Then look at the next 30 minute or next 5 minute. Next 5 minute comes back with strong selling order flow again and gets very, very close to that initial target. Okay, and then I gotta tell you, at this point, I'm scaling out as this thing's going in there. But now I still haven't achieved the target yet. So the question is, like, where do I put my stop for the potential runner? Okay, and where I need to, is either do I get to the target, and when do I move it? Well, I still haven't moved that, my trailing stop from the top there because I haven't achieved the target. And this is the other thing, is like, once you're in the trade, one of the questions you have to ask is, has something changed that negates the trade? In this case, what would make me nervous? Again, if I trade back through the open, if I find buyers that can counter the selling activity and change that. Now note, over the next 15 minutes or so, I actually find some pretty stronger buyers that actually come back up through the open. So, here, this is where I'm getting nervous, but I'm not moving my stop. I'm going to make them take out that high. Because if they take out the high, I want to be out, because then they've negated these sellers. And if those strong sellers can't get and sustain the excursion that you want, then you need to be out. And this is the kind of the first lesson on setting better stops, is that you identify strength and you lean into strength and defend strength. Using a specific price action like a candlestick or something like that, you can't really look inside that and say, you might see it wick, for example, or create some kind of candlestick wick, but you can't see, well, what was the volume like inside of that thing? What was the order flow like inside of that thing? You just know that the period opened and it went up here and it came back down. But I don't know how strong that was. Using like order flow tools along with contract volume, it allows me to see where that strength is and what's going on. And again, this is in the category of I may be wrong. Now, note in this period right here, we get really strong selling that comes back in, a big delta number again. Also, if I look at the histogram of period volume, I get big volume again. All right. Now, after this one, still I'm just moving my stop down just a little bit more. I'm defending that strength. Wherever the strength is. So, I'm going to make them. They'd have to trade up through 53 to get me out. And then in the next 5 minute, we get to the targets, right? We get target 1, we get target 2. Now the question is, okay, how can I trail this thing? How can I trail my stop such that I can, get more of the meat of this trade and even get more than my initial target? So same rules are implied. We're getting some buying. Now this buying here, 454. So just think about this number, 2822. This one's 454. The next one is 223. So I've taken back about 700 out of 2800. So once I've made a lower low here on this 5 minute, I'm going to lean into the next, next layer of strength. So I'd move my stop to the top of this 5 minute, which also is strength. And then note here, it comes back down on additional strength again, makes a new low. I'm going to move my stop down here, which eventually got, and we were looking for, in general affirm this, we were looking for potentially trading all the way through these singles all the way down to 2814, which we didn't get. We got close. I mean, we got within about 7 points of the ultimate target, but it kept you in the trade because look at where all of the strength was. All of the big numbers, all the big delta was to the sell side. All the weaker numbers were to the buy side. So this is what we'd call responsive activity, and they're pulling back. And then every time that there'd be more strength coming in, then you're going to just pull your stop down and go in. And that's actually like institutions. Well, that's where they're layering in additional risk, which is that's where they're adding to the position, not just trailing it, but they're adding more. Like, oh, there's more selling, okay, and I know where I'm going to defend that, and that's why you'd have your stop above that strength. And then here, note down here, there's a big number at 1922, and then note the very next one, the very next 5 minute trades above that. So you have, this is where you had that kind of that last push that gets negated, and now you'd be out of the trade. So it starts with the 4 questions to define the trade. So in this case, what's the opportunity? That it has to be a defined setup. Like there has to be a setup that you're looking at. In this case, it was a structure cleanup trade. We know that trade. We know the behaviors around that. We know what we're looking for. I know what my target's going to be. Now I got to define the risk against that. Now I know what behavior I'm going to look for that's going to affirm being in that trade, and what behavior I would not want to see. Okay, so, and I'm going to find strong behavior in the direction you want to go. Now, if you do not have delta, like if you don't have order flow data, just use period volume, like a 5 minute, like look at a volume histogram across the bottom of the chart and say, like, where can I find the strongest volume in a period? Let that period close. That's the strength. We'll look at another example here in a second. But you're going to align yourself with that strength. And two ways to also defend that. So one is, to go in the direction of strong behavior, or if you find opposite direction that's not getting follow through. And that's this scenario where I had, like, let's say, for example, I was looking to be long the ES. Okay. When I see strong behavior like this that doesn't, strong behavior, strong delta should get follow through. Think of it like momentum of a semi-trailer going down the interstate. That thing's got momentum, and it's very rare that that's just going to stop on a dime. If it just immediately stops, then something's there and it's not going to be able to go forward. Then you can look for it to go in the opposite direction. So, one of the ways then is if I see strong behavior countering that, then I would, again, defend, know to get out, and then defend this new strong behavior here as my stop. And you can see how that actually gave you some pretty decent positive excursion. And that was the biggest number, the biggest delta, which all you're trying to find is, you'll find that your trades will go more in favor if you align yourself with others in the auction who want to go in the direction that you want to do. So, first is identifying where that strong behavior is. And, this is one way is to look at, strength in the delta. If we look at, let's just look at a 5 minute chart here. Now this has, this is just volume. Here's delta. Okay, so this is order flow. Here's period volume. Okay, so you can identify where the really big volume is pretty easily. Okay. Now let's notice out here later in the session, see this little spike of volume here to the buy side? Notice how that held for a nice responsive long. Look at that strength right there. Okay, where do you see another piece of strength? Let's look at this one. Okay, now notice that this one didn't get, you know, an immediate follow through. So that one tries and then gets rejected. That would be a clue of like you would lean into this kind of strength right here if that was an area that you wanted to trigger in the trade. Let's assume that was. That's the type of behavior to go with. But hey, if it doesn't get follow through immediately, you get out. And in this case, it actually gave you another opportunity of strength again that you could lean in and set the stop one tick below that. But the kind of the first step in the process is just get honed to identifying strength. And the other cool part is that when you have tools like where you can combine both volume and order flow, those are ones that give you higher confidence. Now notice that this one had some decent buying order flow that was immediately countered by selling, so that was kind of a neutral behavior. Again, part of this was because of where you were in the profile. You were in the middle of the profile. You're going to find both buyers and sellers. This one on the extreme that kicks back is better because the profile had tapered and you've run out of sellers. So placement is also helpful. All right. When I place that stop, like literally it's one tick beyond where I want to go, and I don't move the stops. If you find yourself moving the stops, then you've likely not defined the trade well, and you don't have confidence in it, or you haven't spent time trying to identify other strong participants that are going in the direction that you want to go that you can join. And again, here's the thing: if you're stopped, fine. Just like that one in that mid session, the ES. If, for example, that was a place that you're looking to be long for whatever reason, I don't know a reason that you would have been long then, but if you were, and if you're stopped, you can step back and redefine the trade. Let's look at crude here real quick. As they're making, we're going to look at crude a couple different ways. So here's one that I had in crude that did not work today. Okay. So one of our setups is something that we call an IB extension go with. So what happens is you have the initial balance, the first hour of trade, and then, so these are 30-minute periods. Then if you extend, so here's the first hour's range. If you extend this range, the question is, do I take the counter trend and fade it, or do I look to go with it? Now, I was seeing some things early on today that the fact that we had opened outside of a prior day's range, pushed lower, came back inside of it, and we were actually finding buyers. So in A period and B period, we had buyers on the order flow. Okay, and then we had weak sellers. And so I was looking for, right around developing value. As a general rule, we look to buy at value or below it, sell at value or above it. I was looking for a trigger to go for an excursion higher, up into this area and higher. That's what I was looking for, okay? And I actually got it. I saw the behavior that I was looking for. We're gonna go here to a shorter time frame chart. Okay. So here's a big, strong move right here on a 5-minute basis with really strong buying delta, like some of the strongest that I had seen in several periods. And then here's the thing. So you see this first move with the strength, you wait for it to complete. And you say, okay, I want this to complete. Now, if I can find additional opportunities in the subsequent periods to go in that direction without trading below the base of where this strength showed up, I will be in the trade. And again, I'm looking for these zones up here and higher in terms of my risk. So, this is a pretty big 5-minute range. This is about 50 cents. So, I was looking for, here's this next one, had, some more buying. Right here, there was some, weakness as well. And I thought, okay, if I get another 5-minute high in the direction I want to go, I will be long. My stop will be 1 tick below the base here. Okay, so that's how it starts. And then I got a little bit of positive excursion. And then you can see that we rolled, in the same 5-minute period, we rolled back through the prior 5-minute and even got to that lower 5-minute. At this point, I'm going, you know what? It's not looking great. But I have my stop where it is. And you can see how in this next 5-minute period, they run right through it. And, very quickly would have been about 20 cents further against me. And even now, I mean, like we're pressing, even lower late in the session. So, and when you see strong behavior like this, that doesn't get follow through. So, and some of it even happened in that same 5-minute period because they probed up here and that 5-minute period actually closed back this way. So that wasn't a really, really great example. But it's good to illustrate if I have, net buying and then I come back through that, then there weren't enough buyers to support that. And I don't want to be in it. I don't want to be the lone guy holding the reins trying to keep this thing going. So, getting yourself adapt to finding where the strength is of other participants and leaning on them is huge.
So you don't want to be holding the door shut is what you're saying.
You do not want to be holding the door because you won't, I mean, your little onesies and twosies isn't going to hold the door.
Really? Come on.
It's not going to hold the door. Now, let's look at a longer time frame. Okay, so we took out that IB high, we've not taken out the IB low, and let's say I was looking at this, to be in crude for, a longer term trade. I still have strength. Like say I was using these, these pullbacks that have happened, even coming back through the open, they've not been able to negate the net buying of the session. So where would I put my stop? 1 tick below today's low. If I want to expand it beyond a 5-minute and say I was using, looking at a full session, I had buying order flow in the day, even, and especially if they can close inside of that prior day's range and retain some of this buying excess, that would not be great. Now I'd much prefer that they would close above or at or above the value today. I don't know if that's going to happen, but they got some time. But there's a lot of buying in this first hour that's still in control. Okay, so I can still lean on that in the overall thesis of the day. Now, if they take out that low and all of the first hour buyers are gone, I don't want to, again, just like Jed says, I don't want to be holding that. I'm not going to be able to hold it. Like it's going to run. Because what happens is when you find areas of strength, there's accumulated stops below that. So that's why when you identify a strong spot like that, once it runs through it, it'll run through it really fast. Have you ever experienced that where like you see a spot and you see like all of a sudden it comes into this area and then it runs real quick? That's because it's run stops because all the stops were right there. So just have your stops with everybody else is the lesson. All right, questions, comments? Is this helpful? Again, the first step is just to if you have delta, period delta, like get tuned into finding areas of strength and just note what happens after those. I mean, look at all of this buying that came in, and this is the cumulative delta, and here's the buying volume. Look at the follow. So here's that initial buying. All of this initial buying is still in control so far. Okay, and this could just be weakness trying to test it and trying to find more buyers. Now, if they come back through the bottom here and they take those out, If that buying wasn't enough to get this thing to go, I'm not going to be able to get it to go, and I can get out and reevaluate and say, why would I be wanting to be long crude? Is there some type of setup that I want to look at? But getting yourself adapted to, I see a strong, like here's a strong selling period down here. Like, let's watch what happens if they can trade back above 25.7 in the close. They might get a pop because there's some late sellers that are trying to push this, and they're going to be wrong. That impulsive activity should get follow through. If it doesn't, then they'll bail. And how do they bail? They're going to buy.
One thing with stops, to what Josh spoke of earlier, moving them or even taking them off, because I think the one thing that we see the most out of unsuccessful traders is they take a really good opportunity and a good idea and they turn it into a swing trade.
Yeah.
Because they don't want to lose.
Yeah.
And then the pain becomes too great and they hop out, and then it's not a good situation. So Josh said something very key. He said, take the stop and let's reevaluate, because obviously something has changed. And so that's why stops are important, because it keeps you in the game. It's just a small, what we call digger, right? And if it's small, you can overcome that with a really good trade. For example, let's say you're more of a swing trader and you have a 10-point loss and you take one or two of those things, but then all of a sudden you get an 80-point runner. Okay, well, you've made up that and then some. So, honor them. Please do. That's honestly, that's the one thing that I see the most out of everybody is either moving the stop or taking the stop out and saying, I'll just hang it. It's got to come back sometime.
Mm-hmm.
What about that person who shorted down at 700 back in 2010?
Yeah.
And they said it had to come back. Well,
it had to come back.
Yeah, it may come back, but it's been 10 years. So just keep that in mind, because it can happen. You can, unfortunately, I hate to say sell the low, but you could do that, and you could also buy the high. So be careful.
Yep. Yes. Let's see a couple questions. Oh.
Well, Arno, that's a great question. We're talking about stop loss. If the delta appears in your favor, then you're moving the stop.
Yeah.
With the thing to protect.
The trailing stop. Yeah.
Yeah, you're protecting your gains at that point. What we're talking about is initial stop loss, where it starts going against you and you start sweating a little bit, and then you're like, I'm going to move it in, move this and give it a little bit more breathing room, and the breathing room turns into a nasty digger. So good question, though. That good catch.
Yeah. That's a key distinction. And there's two modules in our pathway that we talk about. This one we talk about next week when we look at small time frame triggers, and the other one we talk about order flow, and we look at one of the dynamics of people that move their stop is that they don't experience the trade going in their favor very quickly. And this is also just a lesson about, if you're picking better trades, your favorable excursion in the trade, you're going to find that you're spending more time with the trade going for you than the trade going against you. If you find that there's more space or more movement in the trade against you than for you, then just in general, your trade location's not great. You're likely chasing the market, and that's not going to, you're not going to be profitable long term, because a couple things. One, you're going to get stopped a lot. You're going to get run over. It's also going to psychologically hamper you, because you're just going to assume that every trade you get in, like there's absolutely no confidence in what you're doing, and that you have to have confidence even knowing that there are no guaranteed trades. See a couple questions. So Peter, so like where do you start to notice divergences between delta and the auction, and when do you stop believing it? Delta divergence. So what this is where you might see. So typically, an auction that's moving well, like right now, crude is moving lower, and this the price is actually moving with the selling or the deltas, and they're in agreement, they're congruent. If we started to see lower prices, but we were seeing weakening in the selling delta, that would be a divergence. That can be a clue that there's about a turn getting ready to take place. We find that those are more pronounced in trending environments. Crude is not in a trending environment today. It's a rotational day, and so you don't see as much of that divergence there. So knowing what kind of day type that you're looking at is helpful with that respect. Hugo, I see a question about how many times after you make the same emotional mistake should you consider maybe trading is not for you. So I don't know if you're familiar with the concept of a poison pill. So a poison pill is a mechanism in business where you like, businesses come up with ideas all the time of a new initiative, a new product, a new service, and you can have a guess that it's going to work, but you don't know. And you want to do your due diligence, you do your market research and all that kind of stuff. But at the end of the day, you don't know if it's going to work. But you don't want to just keep throwing money at something that's not going to ultimately work. Okay, so instead, what you want to do is you want to set a threshold that says, hey, if this doesn't turn around by X date, or if I don't see certain behaviors, then I'm gonna hang it up. I recommend every developing trader has a poison pill in place, and that can be, if I don't see a consistent win rate by a certain date, if I don't see a certain you can make up the metrics. One, just to help is if you're not yet consistently profitable, do yourself a favor and don't trade live money. Like that, just remove that stressor away. And I know that there are people out there that will say, well, you can't learn to trade if you don't use live money. And yes, ultimately you're going to have to put the risk on. But if you're putting on risk without knowing that you can be successful and not having confidence in it, you're actually doing damage to your brain. You're teaching your brain to fail. It's akin to here in the United States we have Major League Baseball. Some of these guys throw close to 100 miles an hour. Given the distance from home plate to the pitcher's mound, if you have never seen that type of speed, you could step into the batter's box and try to hit that, and you won't even be able to get the bat around before the ball's past you. Okay, trying to trade and be successful without having been successful and done lots of reps to know that you could like actually make contact with the ball is like stepping into face a major league pitcher without ever having taken a swing in batting practice. It's insane. It makes no sense. So if you're not yet consistent, please, please, please do not put live money on the line. That's the first thing. So then as that frees you to be able to try things, record them, test them in a lab, like do all that kind of stuff. And then once you've found that, hey, I've got some edge, then you still set the poison pill to say, okay, now I've got the edge. Now I'm going to deploy live capital around this. I'm going to give myself X amount of time. It's always great to invite someone that cares about you into that conversation. Somebody that, Jed's wife was a trader. So, I'm sure they continue to have conversations about, when's it time for Jed to hang it up?
Oh yeah, I get beat up all the time, believe me.
Right.
But
It keeps him honest.
Well, it does, believe me. I look at that and I go, oh crap, I'm gonna have to tell her about that one.
Yeah.
So one thing that Josh says I think is very important. What you're gonna find is that poison pill is typically not because you have a bad trade set up. Okay,
Yeah.
it's to protect you from you, because
Right.
it's going to be
Right.
you that usually does the wrong things. The challenge here is there's so many opportunities in the market on a daily basis, and you
Yeah.
see them, and you're like, oh, I could have made, I could have made 250. And like what Josh alluded to at the very beginning of the call was everybody is money focused rather than setup focus, or what we call execution focus.
Mm-hmm.
And so when we see people that are what we call going off the rails and hurting themselves and their capital, we don't want to see that. First of all, that's why he says do not trade live money at first. Do your reps and sim and get used to it. What usually happens is when we start to dissect people who have blown out or is getting ready to blow out, what we find is it has nothing to do with their setup, because they're not even following a setup. They're just pulling the trigger because they see it. They're emotional and they're reacting rather than thinking through the process and going, is that really my setup?
Yeah.
So you have to learn. Part of this whole deal is psychologically is let things go until the market comes to you and meets your criteria. That's why we use 4 questions,
Yeah.
because it eliminates a lot of that psychological back and forth between your ears, as far as, oh wow, look at this move, I could have bought the bottom down here and I could have made X number of dollars. Yeah, we all could have done that. Okay. And Josh and I both went through this. I guarantee at times we still struggle with it.
Yeah.
Yesterday was crazy. We had 50 down, 50 up, 50 down, and 50 up. And then after hours, they went, another 100 up?
Yeah.
Okay, that is difficult to deal with psychologically. These are hard markets right now.
Yeah.
Okay, so that's why it's imperative to, for one, use stops, okay, but 2, follow your plan and understand that you're going to let a lot go, and you're looking for the specific ones, as I call them, the layup trades, right?
Yeah.
I'm really good at waiting for layup trades. I miss a lot. So,
Yeah. Yeah. Good point. Peter, so like, how would you determine the quality of a pullback if it's, bullish? So again, you identify what I call a site of origination to push into. Like, let's say, for example, crude here. I mean, now I wouldn't take this trade because we're 8 minutes from the close, but let's say that it was in the middle of the week and crude has balanced. They've consolidated here for quite some time, and you're looking for a push to new low prices. All right. There is a very strong movement right here. Now, these guys just got trapped and they're probably going to get squeezed. But like here is closer from balance. There's about 670 to the delta side. So that's your side of origination. So that's kind of the place that you're like, all right, now I want to see if I can see some weakness pulling back and see how these numbers are less. Like there's 26 to the buy side is a weaker number. So that's a pullback that's weak, and you just want it to pull back and not exceed that high. Like in this environment, here's strong behavior that didn't get any follow through and is immediately getting trapped. So these are guys who were short into the hole, got no follow through, and they immediately got stopped out and should have got stopped out. Like if you were selling at the bottom of the profile, where what is this? This is selling below value. So like, even Peter, to your question about how do you improve trade location, one is to know, like, where are you relative to the profile. If you're selling below value and you're an intraday trader, the only way that trade's going to work is if value shifts in the direction that you're wanting to go. Otherwise, you're ripe to get trapped. Just like these late day crude sellers. Okay, they were selling away from value and got no follow through, and now they've got to buy and cover quick before the close, because they had poor trade location.
yeah, that we call that the old dog on the gravel road.
Yeah.
That's for another day, that story. But it's very true, and it kills. That is a killer of traders. Now, crude here, we close down in 5 or 6 minutes, but if they open that next 30 after the cash close and they run it up above that 30-minute high, all those guys are super trapped.
Super trapped.
It would hurt them.
Yeah. When you say selling below value, we mean volume. So it's volume at price. That helps us define value. And then your discernment as the traders to figure out, okay, within what time frame. And we look at a couple of different time frames. We look at the current day's value. We look at the prior day's value. We look at value for the last week. And we look for value at the last month. Those are kind of our key reference points. So one of the things I think that gave away, especially if you're looking at the NASDAQ, we had some guys short in the NASDAQ today. Okay, the reason to short the NASDAQ was because value was significantly lower on. We'll just pull this chart up.
You can think of it as like a rubber band. Okay,
Yeah.
if you stretch that rubber band far enough, it's going to eventually come back. You let
It's
it go
gonna
from
come
one end and it will come back. Now, will it traverse all the way back to the mean? Sometimes, yeah, a lot of times it will, but those are the areas. But if you keep going in the direction of that rubber band, then you're going to get stuck. And that's what we
Yeah.
call a stuck trader. And again, also think where stops are. That's why Josh said they ran all the stops, and then the buyer stepped in and they got those guys trapped on crude.
Yep. Yeah, they
Yeah.
did. Man, they got them.
They
So
actually
here
one ticked them. Actually, look at that
they
right
did. They
below the
did one.
IBO.
They did one tick them.
Yeah.
So note. Oh, where's my pen? Where's my pen? Oh, here it is. Okay, so here's the Nasdaq. Here is value from yesterday, right here. Okay, we opened here. Value from yesterday was here. Value for the last week is here. Value for the last month is here. Okay, so if you're long and you're above value for the last month, last week, and last day, it's more likely that you're going to find better trade location looking for this thing to pull back to at least one of these value references than trying to buy up here. And one of the clues, this is where, the profile just really helps you, is, like if you look at, and this is the current developing weekly profile, okay? Look at the slope. What does that represent? That represents no participation. So nobody was active at those prices. So if you're buying up there and there's like all of the larger participants are below you, again, unless you find a bunch of participants that can build this out and participate here very quickly, you've got bad trade location, and this is the 9 times out of 10, this is the thing that's going to happen to you, is they're going to come back. So we had guys taking advantage of the short side on this. I mean, this is another. Now the S&Ps was not in the same configuration as the Nasdaq, but this made the Nasdaq a very favorable potential fade trade today.
And you think about it too. Josh pinged me last night, and we were talking about Amazon. Amazon, it was 200 points away from its 5-day.
Yeah.
That's pretty stretched. So that was one you could take advantage of. Now I'm not suggesting selling Amazon, but for example, I used some options and took advantage of that. So
yeah. So like let's look at Amazon for the last month. Okay, here's value for the last month. Now there's some nodes here like 225, 85. There's a node at 240 a little bit, but I mean all of the big volume is below you. So I would want to come back to one of these nodes where I found both buyers and sellers and see that hold to then go long, and then I would know how to defend that as well.
Tesla was one too, as you remember.
Oh yeah.
Came out of the gates in December, and man, it went from like 300 to what? I don't know what it was, 900 and some dollars. And when that thing got stretched way too far, right? Who got caught up there buying, thinking, because they saw the news come out, and we see a lot of analysts and stuff come on CNBC and Bloomberg, and if you're watching those, please turn them off, because they're going to tell you what they want you to hear, which is, hey, this is going higher to 1600, it's going to 3300. I seen even on the news. I was like, oh my gosh, you gotta be kidding me. And that's what exactly happens. They got stuck. Somebody got stuck buying at
Look
the
at
top.
this. This is how you can save yourself thousands of dollars, is that you don't try to buy this. You see this and you go, oh man, it's going to keep going higher and higher. But if you can't look inside the auction and see the quality of the auction, look at where it came back to. Oh my gosh. It came back to the most traded price of this entire move.
Go figure.
Go figure, huh?
So the opportunity was way down below to start legging into that thing.
Yeah. Now, when it came back down here and held, that was a better spot to buy. And look at the move that you got off of that. That's more a durational type thing. All right, gang. It's Friday, and I'm exhausted.
You and me both. It's been a long week.
It's been a long week. NQ's trying to get that 5-day by the close.
They're doing a good job of it.
They're doing a good job of it. And I think I just got an alert that ES is pushing lower still.
Yeah, it is. Cody's getting it. Is Cody with us?
They still got a ways. Hey, thanks for the questions. Thanks for joining. I hope this has been helpful. And for those of you who have not yet spent some time with us, if we give everybody an opportunity to spend a week with us just to kind of work on the development process. There's lots of firms out there that are trying to do skill development, and some are helpful and some are not. Some will be a fit for you and some are not. And so we'd love for you to see if we're a fit, and you can always check that out. But look for strength, lean into strength, and you'll be surprised how that is sticky in your trades. That's all I got.
That's all you got?
Yep.
That's good enough. Hey guys, thanks for spending some time with us. We hope you guys had a good week. These times are a little screwy in the market, so good to review a lot of this information. Even for those of us who've been doing it for quite some time, it's really good to sit back and take a look at it. And hope everybody is healthy, and hope you guys have a great weekend.
Yeah. True story. All right. Peace, everybody.